What's up everyone, it's Scotty with MoneyVest. So in this video, I wanted to go over my favorite chip stock in the market. And it's not Nvidia, it is not AMD, it is a stock that we analyzed months ago. This is a company that's more than doubled in a very short period of time. Absolutely incredible fundamentals. And without this company, none of this would be possible. Quite literally, the ecosystem for semiconductors and chips would fall apart. And a lot of our dedicated subscribers and members would already be able to guess what company we're going to talk about in this video. So hope you all enjoy it and find it helpful. I'm going to be using our MoneyVest platform. I'm super excited to build this and of course bring it to life for all of you. There's going to be a lot of amazing features and tools that we're going to be adding over time. So if you want to get access, the early access to this platform, which again, we're going to be launching on July 8th. Link's going to be down below. Right now, we're offering a huge discount of a 51% off, and you can lock this pricing in for life. It doesn't matter whether you use this platform for 2 years, 3 years, 5 years, or 10 years, you're going to be locked in at this pricing forever, for life, because eventually when we're adding more data, pricing is going to go up because our cost also goes up because we're adding more data sets and more functionality, more features, more updates to the system. So link's going to be down below. We'll love to have you on board with the very limited spots left and of course for a limited time as well. So the company that we're talking about today is going to be none other than ASML. Now ASML is a company based out of the Netherlands. It's listed on the New York Stock Exchange. It's done incredibly well. It's up to over $1,000 a share. If you take a look at the year to date gains, of course, amazing returns here. It's up over 41% on a year-to-date basis. And if you come over to the max chart here, you'll see how incredible the gains have been for this company. I mean, it did have a little bit of a dip here, of course, in 2022, but then since it's just been on an absolute roar, pushing up to a new all-time highs of well over $1,000. I had this stock. I did exit out of my position with a massive profit, but this is a company that it's always going to be on my radar for the long term. We'll once again look into this company. If it comes down, better prices, better valuations, better risk reward, I will be all over this stock because this is a company that builds lithography equipments that are essential for the beginning of the ecosystem. So again, ASML essentially develops, produces, markets, sales, upgrades, services of advanced semiconductor equipment systems. The company headquartered in Netherlands here employs 41,500 full-time employees and operates through subsidiaries in Netherlands, United States, Italy, France, Germany, and the United Kingdom, and servicing advanced semiconductor equipments. And one of the biggest customers for them is going to be TSMC as well, because they do buy a lot of lithography equipments from ASML. Now this right here, as you already know, is a key statistics table which gives you a little bit of an overview of the company's margins, efficiency, of course, financial health. We got valuations and we've got growth, and this is all on a either trailing 12-month basis or on a most recent quarter basis in terms of financial statements. So either you can look at this snapshot and get a bit of a sense of how well or how poorly the company is doing, or we can go over to our functionality, to the MoneyVest metrics, which is what I prefer and like, because I can switch over between different time zones, time frames basically, and I can also plot a lot of really amazing charts. So you can see how well the revenue's been growing for the company, going from about under $10 billion to well over $25 billion here for the company as well. So if you come down, let's just plot gross profit. Let's plot operating income. We got net income, and then also do free cash flow as well. And now you've got a nice visual chart showing you nothing but consistent growth in the company in terms of every single metric except for free cash flow, which has been declining over the last 3 years. So it's gone from 9.9, just under $10 billion, so down to 7.2. And then of course 2023 we're sitting at under $3.4 billion, but nonetheless a very nice consistent growth in margins. And then if you come down to speaking of margins, gross margins, operating margins, net margins, and free cash flow margins, you plot those numbers in. So you can see the free cash flow margins are the ones that actually did decline quite a bit because of the free cash flow coming down, but everything else has been relatively stable. We're looking at 49, almost 50% gross margins with, of course, operating margins over 34%. And net margins of just under 30%. So highly profitable and a highly growing business. CAGR here has been very strong, 7-year CAGR. We're looking at for revenue at just under 22%, gross profit 24%, 25% for operating income, 25% for net income, operating cash flow, free cash flow also growing very nicely, with shares outstanding also going down by about 1% in the last 7 years here for the business. So again, just a lot of these really high metrics, and it scores really well. To be honest, it scores a 3.82 out of a 5 for our M score. So we've basically assigned numerical values to each company, which of course you can take a look at on the platform, where the closer it is to 5, the better the company is. And you can see on a last 7-year basis, high growth across the board. This right here, margins expanding, except for operating cash flow, free cash flow, which I mentioned earlier because it's been coming down slightly. And then if you come down to efficiency for the business, we're looking at highly efficient business, as well as very stable numbers for capex as a percentage of revenue. On average, it's been under 10%. And operating leverage of over 1. That means the operating income is growing at a faster rate compared to the growth in revenue. And then we got return on assets averaging about 14.3. Last year is just under 19%. And return on equity over 50%, which is significantly better than the average of about 34% on a 7-year basis. And return on invested capital over 37% compared to 26% on an average basis. So again, a lot of these metrics are very important for us when we're doing a objective fundamental analysis, right? Because these are the true story behind the company. These are the numbers that we're looking at. Now, in terms of the financial table, so financial health of the business, you'll notice that cash is improving 10% on a compounded annual basis. Debt is also increasing by 5.6 over the last 7 years. So they've gone from about 3.13 billion to now sitting at just over 4.8. So debt is also increasing. That's why it says, increasing over here in red. However, cash is increasing at a much faster rate, which is exactly why they've got a negative net debt, and that is, of course, very good for the company. Current ratio is 2.1, quick ratio is 1.4, debt to free cash flow 1.2. So all of these are very good to excellent numbers here in terms of financials. And goodwill as a percentage of assets, I do want to highlight this because right now it's sitting at just under 20% and they've averaged about 26%. So that tells us the company does have a lot of goodwill compared to other assets. So about 20% of their total assets are in goodwill. And that's something that we don't like. And that's why we've assigned a M score of 2 out of 5 because that's not a good thing, right? We want the company to have actual hardcore assets. And that's, cash, property, plant, equipment, actual physical assets as opposed to goodwill, which are intangibles. So you can, get that level of insight in our platform as well. And of course, cash to debt 1.65. We've got solvency ratio that is very good, 34%. Inventory as a percentage of assets, also 20%. So that is a little bit on the higher end, slightly higher than the average of 16.8, but still manageable and still, I would say, good for the company here. So moving forward to the final piece, which is the valuation, right? So we covered growth, we covered margins, we covered efficiency, we covered financials. Let's talk a little bit about the valuation. And that is exactly where the problem somewhat is, because if I remove everything from the chart here, so let's just, get rid of everything and we'll only focus on the valuation piece. And the cool thing is that you can actually start to look at a lot of other really interesting data. So what I like to do here is that I want to see the trend for whatever stock I'm analyzing, right? So how the valuation has fluctuated over the years. So we're going to plot price to earnings. We're going to plot price to sales, price to free cash flow. Let's just do price to operating cash flow, and then let's just do enterprise value to EBITDA as well. Now, if you come back to the chart, you'll notice that, ASML more or less is trading at in and around the same valuation it's traded in the past. However, for some ratios, so more specifically over here, price to free cash flow at almost 89 to 90. And the reason for that is because of the decline in free cash flows in recent years. You'll notice that I showed you earlier that free cash flow has been coming down. And for that reason, the baseline has been around the 40 mark for price free cash flow multiple. That's the blue. And of course, a significant spike here to almost 90 here. That just goes to show that, okay, that multiple needs to be checked. The other one being operating cash flow, that also increasing to 42 when the baseline in the past has been closer to 20 to 25. And then finally, if you take a look at price to earnings, which is also very important, that of course is coming down to a lot more reasonable level. But this is as of 2023, right? So this is not the trailing 12 month. This is not as of the recent price earnings multiple, which I'll go over in just a minute according to the ratios. But it's a good sort of way to kind of assess how the valuation's been in previous years, right? In terms of the market cap and of course the earnings and the cash flows and revenue, what's been the average or somewhat baseline valuation for the company. Now you can also come over here and do something very similar, right? So you can also plot a lot of different things. So what I like to do here is come over to the balance sheet, look at the company's cash, and also look at the company's liabilities. So long-term debt, as we already know, the company's got negative net debt. That's good. So that means they've got more cash than debt on the balance sheet. This is just a visual way of taking a look at that. And then if you want to look at the quarterly numbers, so let's just come over to quarterly, and we're going to come over to the last 8 quarters. And now let's look at the total cash versus total liabilities and also long-term debt. And you'll notice liabilities, of course, are more at $26 billion, but the company still has more cash than debt on the balance sheet, right? So we're looking at over $7 billion worth of cash as of December 31st, 2023, versus long-term debt sitting at $4.6 billion for the business as well. And then finally, if you come over to the free cash flows, if you come over to cash flows, select this, you'll notice that, of course, it's been down. 2023 quarter was down to 149 million, but a little bit of an increase of 3.2. So they've been a little bit fluctuating with their free cash flows in the past. And of course, this right here over the last 3 years, as I've already shown you, it's been coming down. So let's come over to analyst estimates. You know what? Before that, let's just go over to ratios. And if you come down to ratios, you'll notice that the trailing 12-month price to earnings multiple for ASML sitting at over 52. Then we've got a forward multiple of 62. Then we got price to free cash flow sitting on a trailing 12-month basis at around 124. So really, really high. And price to sales on a trailing basis sitting at over 15. So that is true for most semiconductor companies, for almost all semiconductor and chip stocks that it's been trading, at a very, very expensive to high valuation. We are starting to see a little bit of a pullback in NVIDIA today. And again, semiconductor stocks in general are starting to roll over just a little bit. So if you come over to Analyzer, and before we do that, if you come over to Analyst Expectations or Analyst Estimates, this right here are going to be some of the targets that analysts have on this stock. They're expecting, as much as $1,400. So that is going to be on the high price target, $1,400 to a low target of $685 with an average price target of $1,100. And that would just mean about a 10% increase from its current levels. Now, if you come over to the EPS and the revenue expectations for ASML, so this is, starting in 2023 all the way up to as much as 2031. So that's how far we're going out to. So 2023 all the way to 2031. EPS expected to go from about $20.59 to almost $69 per share. An amazing number, and we're looking at this as being the CAGR or the CAGR for earnings per share. So negative 6% all the way to as much as 16% in compounded annual growth rate for the next 8 years. But the number that we're going to be focusing on is going to be this number right here, 17.2%, because this is the next 7 years worth of CAGR for ASML. So 17%, keep that number in mind because we're going to be using that to better understand what's going to be the potential growth rate for ASML moving forward. And same thing is true for revenue. Revenue is expected to grow at a much slower pace at over 11.5% over the next 8 years. And this again is going to be the year-over-year growth, and the CAGR revenue expected to grow from $27.5 billion to just over $66 billion for the company by 2031. So now we move over to the Analyzer tab to figure out, okay, what's the appropriate intrinsic value for ASML? Where would it become a buying opportunity once again? So about $8 billion in net income as of 2023. Let's just forecast for 7 years out. And we're going to plug in a growth rate of about 17%, which is kind of the normalized number based on analyst expectations. You'll notice that the expected PE multiple over the last 7 years on average has been 35. But that's, in my opinion, a little bit more on the higher side. So I can go with 25 here. And again, if I go down on the PE multiple, valuation is going to come down and intrinsic value is going to be lower. But that's the whole idea of us being objective and just letting numbers decide for us. Of course, there's a qualitative piece. Of course, there's another analysis that we need to do to figure out, okay, whether the stock is investable or not, whether it's got a better story, what kind of moat does it have, what kind of future does it have. But at the end of the day, it all comes down to numbers, right? If you're able to analyze numbers, and that's why, I've built this, because I think it's really important to visualize and look at tables, look at charts, look at numbers to better guide your investing process. Because that's really what it comes down to. It's a process, right? You can't just bet on something or invest in something just based on stories. You need the numbers backing your decision. And this is where you can come back to if something happens, if something goes wrong, if something good or bad comes along, you can always come back to your numbers and figure out, okay, what were the assumptions I was making and whether the company is hitting those assumptions or not. So 17 times growth rate, 17%, 25 times PE multiple, negative share dilution. So that's good because the company's buying back shares, same discount rate, same margin of safety. If you hit calculate, we're looking at a 36% overvaluation for ASML with a fair value sitting at just under $700 per share. And I was kind of confident that it's going to be somewhere around those levels because I actually ended up buying an ASML around the $500 mark, and then I exited around the $900 mark, so I made pretty good profit. But that's going to be the level because I do believe the valuation's very expensive for the company right now. And if you come down to the sensitivity grid, and this is what it looks like, of course, the higher you go in the PE multiple, the higher you grow in terms of the growth rate, that's how you're going to change your intrinsic value on the business. Of course, if you go further to the left and of course further higher, then it's going to be lower in terms of that intrinsic value. But for now, it sits roughly under $700 per share. Now, if you believe that it should be trading at 31 to 33 times earnings multiple, and it deserves at least a 21 to 23% growth rate, then you're going to be sitting somewhere over here. And that is going to suggest that ASML already is trading at its fair value. So already trading at its intrinsic value. So that again is up to you. So that is the sensitivity grid that I wanted to go over. Hope you all enjoyed this video. Very quick technical analysis on the stock as well. So if you come back on the technical analysis on TradingView, again, we've already talked about how it's been hitting new all-time highs, trading just over $1,000. And this right here is going to be the complete breakdown with a support, massive support sitting at $870 to as much as $850 per share, with a much stronger support sitting down as much as $771 for ASML as well. Maybe it is not. Yeah, so it is. It is hitting its all-time highs. So 850, 860s. So this right here, previous resistance from back in 2021, very strong support over here, all the way down to 750s. And again, this would be a huge buying opportunity for ASML once again, if and when it actually sees those levels once again. We'll find out, of course, soon enough. But new all-time high, RSI coming back up. There is a little bit of that negative divergence on the chart as well. So a little bit of those lower highs compared to the higher highs for the price itself. So there is that negative divergence that we're seeing for ASML at the moment. So hope you all enjoyed this video and a complete update on ASML. Let me know your thoughts down in the comment section below. And as always, if you want access to this platform where you can do a lot of really cool stuff, link's going to be down below. Happy investing, and I'll see you all in the next video.